Can the market hold Monday's gains? BHP and Woolworths, and we'll have a look at financial planning. There's no Marty, there's no Peter, and I'm Paul, and I'm mad about money. Look, we've only got a couple of minutes, but first of all, I've got to beat up on Peter and Marty. Peter, for some reason, felt that he could stay down and watch the tennis a little bit longer. He'll be back on his show tonight, but couldn't make mad about money. Thanks, Peter. And Marty, well, he's on holiday somewhere, so you're left with me. Okay, enough of a beat up on our colleagues. First of all, can the market hold Monday's gains? Now, don't read too much into Monday's market performance. Up 91 points, almost to nothing. Everyone who had better reason wasn't around on Monday. But a good leader from the US last night, up 282 points, 1.78%. A little bit higher than where it closed on Friday after we take into account Monday's down day. Again, most importantly for the US, oil has stabilised a little bit and we've seen some good earnings reports from 3M and McDonald's. On the downside, Apple's reported after the bell, it beat on earnings, $3.28 versus $3.23, but missed on revenue and also forecast its first revenue fall in many, many quarters. It's expecting first quarter of 2016 to be down on the last quarter. Okay, so I don't think the US is going to like that. Apple's down a little bit in a post-market trade. More importantly for our market, two things have to happen for us to hold this level. We need commodity prices to stabilise. Maybe oil is finding a bit of a bottom here, who knows, but he wouldn't yet call it all over. And secondly, what's really important for our market is, of course, coming into earnings seasons, we need to see some good numbers coming out of our companies in the coming weeks ahead, particularly a bit of top-line sales growth. It's a bit like the US. Earnings reports are really important for the US market. I think they're the same for our market. I don't think we're out of the blues just yet, so don't get too excited. Look, maybe today we'll see a little bit of early buying pressure, but I think over the course of the day, other factors will take hold. Anyhow, that's the market. I think we're still in a bit of a trading range. I'm not yet convinced we've really broken 5,000 on the upside, so save onto those pennies. Anyhow, let's get on to some company news. I wrote about Woolworths in the Switzer Daily last week. Why is it so hard for Woolworths to find a new CEO? I also said that the Masters thing was just one of the four things the Woolworths board needed to do. And if you look at what's happened since the announcement came last Monday, you'll see that the big winner has been Wesfarmers. In fact, since Woolworths announced their changes, the price of Woolworths shares are up 7.2%. The price of Wesfarmers shares are up 7.1%. So despite all the good news about Masters, Wesfarmers has rallied as hard. They're the winner out of the Masters closure. But coming back to Woolworths, why on earth can't they find a new CEO? It was last June that Grant O'Brien announced he was stepping down. We're now into almost February. No sign of a new CEO. And the problem with new CEOs is that when they come in, they may want to make changes. They need to change the culture. They need to change the management team. Woolworths is by no means out of its woods just yet. So don't get too excited about Woolworths. On the other hand, BHP, friendless, above $15. No one likes BHP. Talk about closing its listing. Again, commodity prices need to bottom before you get too bullish about BHP. What I really want to see, and perhaps you can agree with me or not, I want to see a bit more blood at corporate board level. I mean, how does the Woolworths board get away with presiding over so many billions of dollars of destruction? And how does Jack Nasser at BHP get away with presiding over so many billions of dollars of shareholder destruction? Sure, commodity prices have come down, but hey, Jack, you are the one who signed off on the acquisition of the oil fields in the US. You are the one who signed off on the potash bid. Look, as in most cases, most BHP acquisitions have been bad. It's time for some renewal, and somebody has to take the blame. Not just a matter of blaming the CEO. There needs to be a little bit more, I'm going to fall on my sword when these things go wrong. More change at Woolworths, more change at BHP, as if just to make you and I as shareholders feel better that someone else feels their pain. If you agree with me, tell me. If you don't, you can tell me I'm wrong, but I think I'd really like to see corporate Australia, corporate governance is not just about making sure the company is doing the right thing, it's also about making sure CEOs don't do the wrong thing and make huge strategic blunders, and when they do, someone in corporate Australia has to pay the price. So, more directors, time to fall on your sword. For our finance tip this week, I'm joined by David Hardman, the Head of Financial Planning at Switzer Financial Group, to talk about why you potentially should see a financial planner. David, Who are the people who see financial planners?
They typically fall into three categories, Paul. There's the accumulators, there's the people who are just coming into retirement, just want to make sense and make sure have we got enough and bring it all into a sensible strategy for them. And then there's the retiree market, which is, have I got enough? Is it going to run out? Or I want to have a certain amount of money to pass on to beneficiaries, whatever the case.
So I'm in the accumulating phase still. Yep. So what value can you add for me?
For someone like yourself, Paul, it's about working out what do you want and then working out are you on track relative to doing that. Most people who are accumulating, they have mortgages, they have kids at school, etc. They've got all these competing demands for their cash flow, but they've also got this provisioning for retirement thing, which is pretty important. So for most of these people, it's about working out can they actually do all these things and fit that within their budgetary constraints, etc.
So I'm now sort of advanced a little bit. I've got even less hair or no hair. I'm about to retire. What are the things that you should be helping me with there, or how can you sort of help as a pre-retiree?
For that group, it's about, okay, so you've built up, the kids have gone, the mortgages have gone, etc. Typically, it's about I've got all these different money inside and outside of super. How do I bring all that together to actually there's a certain amount of retirement income that I want, that I need, that I want to maintain my lifestyle. How do I bring all this together into a cohesive kind of strategy that's going to allow me to do that? And have I got enough? And is it going to last?
Okay, so I'm now retired. My golf handicap has actually crashed because I'm out there 3 or 4 times a week. How are you helping me when I'm in the retirement phase?
For the majority of the retiree people, it's really a case for them about it's the same as the people leading into retirement. Have I got enough, and is it going to last? There's a real concern out there around that issue, and it takes some time when people get into the retirement kind of phase of their lives to sort of to get comfortable with that. But really, for a lot of those people, it's around that. The key issue is, have I got enough? Is it going to last? Or I want a certain amount that I want to be able to hand on to people. And across those courses, those periods of time when we do get volatility in markets, it's around what impact is that having? And do I, for example, need to take a pay cut? Or when markets are really being quite as a fair win, can I take a pay rise?
So is a good financial planner like a financial coach?
Typically, yeah, absolutely. That's part of the role. Sometimes it's about telling people, gee whiz, we need to, you shouldn't be doing this, or...
So you tell me what I shouldn't be doing, right? You're going to sort of...
Absolutely.
You slap me over the wrist, or...
Look, in a nice way, but sometimes, it's...
You've got to save me from myself, right?
Financial planning is sometimes it is saving people from themselves, absolutely.
Yeah.
So, you can be a financial planner, a good financial planner, in a lot of cases tends to be full-time psychologist, part-time financial planner, Paul.
Okay, let's move on. I don't want to make too much a promo for Switzer financial planning, but look, financial planners have had a big, on the nose in many parts of the community, a lot of really bad publicity. Why are you different? Why is your team different?
Look, at the core of what we do is a lot of the problems that have been caused around financial planning a lot of it's been caused by remuneration issues. So the key difference about this business is we just charge a fee for the work that we do for clients. So no commissions, no conflicts of interest, all that sort of stuff. So the revenue model is a real driver of the problems that we've had. It really is core to that. Our revenue model is very different about how we charge people, how we work with them, and how we build relationships with them. So in that sense, that's where we differ a lot from our colleagues out there in the industry.
Okay, well, I think that's the bell. On that note, it's probably time to end up Mad About Money for this week. David, thank you for joining us. There was no Marty. There was no Peter. I'm Paul.
I'm David.
And we're mad about money.